Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I am Billy and I'm joined by my co-host,
Andrew. Bills, here we are back again in nice and sunny Melbourne for once, and we're back again for another podcast.
We are back again, Andrew. Always back again for another podcast, hitting the podcast airwaves once a week.
Very nice, very nice.
I was going to say radio waves, but anyway, here we go.
Yeah, radio waves. You're really showing your age, aren't you?
Thanks, Andrew. And before we get derailed
39,
into Forever 39, so Andrew, tell us, what are we talking to everybody about today?
Yeah, so today we're doing a topic that is really commonly debated. I mean, I think we hear it all of the time, and it's shares versus property investment. What should I be doing? Where should I be parking my money? Should it be in a parcel of shares? Should it be in a property? What are the benefits of each, and which direction should I be taking?
Yeah, and I think it's a really common one, like you had just pointed out, that we get asked that question and we speak about it all the time, because I think from a property perspective, it's a lot easier to understand because it's tangible. When you talk about residential property as an example, you can see it, you can feel it, you can touch it, but you understand intuitively that that's where people live. So you're like, okay, I understand the investment. I feel a lot more comfortable with it. Whereas with a share, if you're not necessarily in that world or haven't had a lot of exposure,
it's a bit harder to...
it's not as tangible, right? It's not as tangible, but it doesn't feel as real to some people. So anyway, we're going to go through that and hopefully demystify a little bit of it and talk through some of the key attributes associated with both of the types of assets that we're talking about, and hopefully give people a little bit more of an understanding, a little bit more confidence around the different asset classes.
Yeah, absolutely.
Andrew, take us into it.
There you go. I was gonna lead you to take us into it, but that's all right. I'll take us into it. So look, I guess the first point in call or first point to start is sort of what is a share. I think people. Not I think, but 99.99% of people understand what a property is, right? Like you purchase a property, there's, a tangible asset in a property there. There's some land associated with it, hopefully as well. And there's some rental income and hopefully some capital gains that happen with it. And so some of the demystifying is what is a share. And a share is, the name itself kind of tells you everything about it, right? It's a share of a company. So you're taking a parcel or an ownership of a particular company when you own a share. Now, granted, your ownership is not the same as if you own a small business and you own 50% of the asset. Your ownership might be, let's say you've owned one of the big four banks. You might have by percentage a very, very small ownership. So you don't obviously have any decision-making power. You obviously don't have any benefit from being able to influence the company in any way. But what you do have is an ownership or a percentage ownership of that company. And as that company makes a profit on a yearly basis, they will distribute, or they may distribute, a portion of the profit out to the owners of the company, and you as a partial owner will receive a portion of the profits in the form of dividends. And in addition to that, as the company becomes more valuable, because they may, take up a larger space in the market, or they may have, done any number of things to make their business more valuable, as does the value of the company. So when you kind of compare shares versus property, the share price is kind of like the property price. It can go up and down depending on how desirable that asset is. And the rental income that you get from a property can kind of be compared to the dividends that you receive in profit distributions when you own a share.
Yeah, no, look, well said, very succinct, very clear on that point. Probably the only thing that I'd add, just because of the intangibleness that people think exist with shares, they're representative of a business. Yep. So we'll use something, I don't know, we might use, say, Woolworths, right? So everybody understands the supermarket. You'd own a share of Woolworths or a parcel of shares, and albeit a very minute number because it's such a large business unless you're an institutional investor or unless you're extremely wealthy. But the thing that I think people fail to realise is, and it's probably no different to a smaller business, but this is more on a much larger scale because it is a bigger business, but there is a professional management team that is installed in that business to make decisions on behalf of the shareholders to try and optimise the business's performance. So when you look at it in that regard, I kind of think about it, and we're in the industry, so it's a little bit different, but I kind of think about it, and that gives me a lot of peace and mind and comfort because you do have hopefully trained executives running a business that they've got a lifetime of experience in to try and operate that business as efficiently and as profitably as it possibly can be.
And there's also, in addition to that, I mean, it can seem intangible because it's so large, but there's a tangible asset behind it. There's a business, there's an operation, there's intellectual property, there's potentially the property that the business owns. So you can have an ownership in shares that actually owns property. They might own the land that their business operates out of. And so there's certainly, when it comes to shares, a tangible asset that sits behind it. It's not like it's just a number on the screen and there's nothing there. I think it's just a lot harder to visualize, and that's sort of in some people's mind what the barrier is when you're talking about shares and property.
Yeah, and I think that's the thing. Like using Woolworths as an example, you can go to the supermarket. We all do anyway, so we understand what that looks like. But let's take a different business, like a carsales.com or a realestate.com.au. That business there, it's all about the online real estate space that they've created through the app and through the website. So it's not as tangible because you can't necessarily go to realestate.com and feel and touch it the same way that you can with a Woolworths. But it's I think, and the reason why I've chosen those two names is because I think they're household names and everybody understands what they are. So there are slight differences, but it still comes back to, in my opinion, the businesses are still being run to maximise profit, and they've got a professional executive team that are in there that are making decisions on behalf of the shareholders, which gives me a lot of peace of mind and comfort around, I guess, what that looks like. And every business operates and performs and succeeds differently in different markets, and I guess that's the fun of it and the challenge associated with picking the right quality companies and the good quality companies that are going to perform over the longer term and pay a good rate of return to the or a good return on investment to the shareholders.
Yeah, absolutely. So Bills, tell us, I mean, look, shares is a very, very broad term.
Yes.
I mean, what are the different type of shares that investors can purchase?
How far and deep do we want to go? I guess on a really high level perspective, the companies we've used the examples of Australian companies.
Yeah.
That also applies to overseas companies as well too. So there is a difference between an Australian company versus an international company. And I guess some of the things to also take into consideration, which helps muddy the waters, but someone like a Woolworths, as an example, their operation would be Australian based.
Yep.
So the majority of their earnings would come from Australia. Whereas let's take someone like a BHP, where a lot of the stuff that we dig out of the ground here in Australia, and they've got operations overseas, but they sell offshore as well too. So even though they're an Australian-based company, a lot of their earnings are derived from stuff that they sell overseas. So it gets a little bit complicated. It gets a little bit muddy because of globalization and exporting and things like that. But you can get on the share market companies that operate in Australia or are listed on the Australian Stock Exchange. Then you can have companies overseas that are listed on an international stock exchange. So I guess the key message here is, we differentiate between Australian shares and international shares as well too.
Yep. And then, as you said, there's companies that may operate in Australia but have an international market that they sell to, and vice versa as well. I mean, I guess sort of in that as well, you've also got what people refer to as blue chip companies, so your big, sort of more stable companies. You've also got your small caps, so your really small companies that might not be worth a lot but have a really significant upside potential, but also downside potential. And so I guess no share investment is the same, and trying to categorize it as one thing is, I think, probably a little bit disingenuous to the share market, because there are so many different types of assets and so many different types of sectors that you can ultimately invest in, which will yield very different returns from each other.
Yeah, and I guess the Australian market as well too distorts it even further, because in Australia we are such a small company when it comes to the global companies that are listed on a stock exchange, but the main part of our share market is made up by the top 20 companies in Australia. You've got your 4 banks, you've got your 2 grocery chains, you've got your 2 miners, and so on and so forth. So that makes it even more complicated. But going back to the difference between blue chip, which would be those companies that we were talking about, to give it a little bit more context, if you think about a smaller business, and I'm going to go back to the grocery store one, but if you think about, and Aldi aren't listed on the stock exchange, they're a German company, but if you take Woolworths, and they're a bigger business versus an Aldi being a smaller business, you tend to think with smaller businesses, they may have greater growth opportunities because they can move faster and they're not as bogged down with things like complexity and costs and inefficient operations. So as an example, if we were working as executives in Aldi, we'd make a decision and maybe we can execute really quickly because there's less layers of management, there's less things that we need to deal with. Whereas if we're working for Woolworths and we make a decision, maybe it takes a lot longer in order to make that decision and execute that. And I guess how that translates to the performance of the company is if we execute and make decisions quicker, then we perform better and faster. So there is a difference between the growth expectations around blue chip companies versus small cap companies, which is what Andrew was referring to before.
And I think within that as well, like a blue chip company, normally you'd expect a lot of the profit that the company derives for that to be paid out to shareholders because they've executed a profit, whereas a smaller company, a lot of their profits, they won't necessarily distribute that out. You won't be receiving a higher amount of dividends because they're reinvesting that back into the company in order to, gain a greater market share or do something to expand the business as well. So how that works from a dividend side of things is also very different as well.
Yeah, no, well said. Andrew, let's pivot into property now. What are the different types of properties that we talk to people about?
Look, mainly, I know there's more, but mainly there's 2. There's residential property and commercial property. You can talk about, farmland and rural land and things like that. But the main types of property that generally we see investors go into is either purchasing a residential property, which is property in which people live in. So you think your standard property investment, and then a commercial property. And a commercial property is essentially somewhere where a business will operate out of. Whether that's a factory, whether that's a shop front, they will perform very differently to how a residential property investment will.
Yeah, and look, just on that note, as an example, so our office here, we're an office space. You compare the performance of an office space, and we're seeing it in cities and CBDs in particular, but with businesses that operate like ours, where they're operating out of an office, obviously COVID's had an impact on working arrangements. So office space needs to be a lot more flexible now. So something like this may get, or the CBDs of the world or Australia may get devalued because businesses aren't necessarily in there as often as they need to be, and they've gotten a little bit more smarter in terms of utilisation of the space, and maybe they've got rotating teams in terms of team one works the first couple of days of a week and so on and so forth. So that can change the profile of that. But then you've got something like warehousing and logistics, where things like online deliveries and the like continues to grow year on year, whereas that commercial space is a lot more valuable and in demand because the cash flows from an investor perspective are a lot more predictable. Whereas with this sort of stuff at the moment, I think we're going to go through some interesting times once these longer term lease agreements start to pop out, and then business owners make a decision on whether or not they renew or they look at something a little bit more flexible.
Yeah, no, absolutely. I guess, sort of giving a bit of a summary as to, what property is, what shares are, and the combination of, or the differences between those 2 types of assets. I think one of the big things to discuss is what are the costs, what are the barriers to entry, when it comes to making a decision on purchasing either, shares or property.
Yeah, and this is absolutely huge, and it's amazing in my mind and in our experience when we see this, how not necessarily overlooked this is, but how it's just it's understood, but then it's kind of like, yep, tick, away we go. Let me explain. So you can buy a share in a business for a reasonably small amount of money. So essentially, you're going to pay brokerage, which is the cost of the transaction, which is quite cheap. It can range from, $5 all the way up to $30, and it depends on how many you buy and what volume it is. And you're buying at the share price of whatever that is, and you can determine how many shares you want to buy based on how much money that you need to invest. But essentially, you could do that and buy into a share for a really cheap amount of money with the amount of money that you've got available to spend. Plus, above and beyond that, you can purchase that Monday through Friday when the stock market is open. So there is a market for you to be able to buy and sell stocks.
Almost immediately.
And assuming that there's enough people wanting to buy and enough people wanting to sell, and there's a market, which in Australia, for at least the majority of the companies that are listed, that doesn't seem to be an issue. And that can happen really quickly. With property, whether it's commercial, whether it is residential, the barriers to entry are a lot higher because you need a lot more money, and usually borrowing starts to come into the mix here, but you need a lot more money in order to purchase that particular asset. So let's take something simple like a residential property, and you buy something for $800,000.
Yep.
You're going to need a deposit. You're going to need a loan. You're going to need, in most instances, to pay stamp duty. And that transaction is going to take time for you to do. Even if you found something tomorrow that was ready to buy, that's not going to settle for a period of time. So in order to do that, in order to purchase property, the cycle time and the barriers to entry are a lot longer.
And the other thing that a lot of people forget in that transaction as well, there's the cost of executing the transaction.
Yep.
But you purchase a share, you invest however much money you want or have in order to purchase those shares. You purchase a property, hopefully you're prudent enough to leave a significant buffer on the side in that if I need repairs, if I don't have a tenant, if something happens from a cash flow side of things, there's money there and available in order to be able to pump into that property. That's not necessary when you're talking about shares, unless you're doing it for, other means outside of that particular transaction. So it's not only the cost of entry, which obviously is significant, but it's also the additional money that needs to sit aside in order to, facilitate any further things that will also need to happen, which is just a non-issue when it comes to, an equity or share investment.
Yeah, no, absolutely. And we're always going with this next part about ticking the box and moving on. And it's a lot more relevant now than what it has been previously. But with the majority of property purchases, for most people, you're talking about taking on debt.
Yeah.
So using that hypothetical scenario that we were talking about before, of an $800,000 purchase, maybe you put down a 20% deposit, so you need $160,000, plus you need stamp duty, which would equate to about $45,000. So you need, in order to purchase a property for $800,000, you need about $200,000 of your own money.
Yep.
If you're borrowing at 80%. The borrowing amount is, what are we talking, 800 less 160, so we're talking 640?
640.
In terms of the borrowing amount that you've got. Now, once again, I think 640 at a 6%-ish odd interest rate versus 640 at a 2% interest rate is a completely different conversation because it comes back to the cash flow ramifications. But what I want to point out, and we're not, and we'll talk about this later, but we don't lean one way or the other. We actually suggest to do both when the timing's right and with the right strategy and bits and pieces. But
you just spoiled the ending, Bills.
No, because I don't want to sound like we're one way or another, but I think it's prudent to not overlook the severity of signing on the dotted line and signing up for a large amount of debt.
Yeah.
And we keep coming back to the sleep test.
40 winks.
Well done, Andrew. Well done.
We are not sponsored by 40 Winks, by the way, but we are chasing their sponsorship.
We're not sponsored by them yet.
Although we keep saying 40 Winks, and I think it kind of comes back to the old saying of, why would you purchase the cow if you get the milk for free? So we're giving a free plug here, and they're not needing to pay anything. So,
Side note, completely irrelevant. I actually bought a new bed from 40 Winks recently.
really?
Yeah.
Oh, there you go. So you're supporting them, and we're talking about them on the podcast, and we're still getting nothing back as a result of it. Sorry, I digress.
Very true.
We've gone completely off track here.
Very true, very true. So yeah, anyway, my point was needing to pass the sleep test and not
comfort levels associated with-
not overlooking that that aspect. Absolutely.
Yeah.
Yep.
Yeah. I mean, look, you sort of touched on it when you sort of talk about shares versus property. A lot of the consideration for most people is all good and well. Let's say you pass the test in terms of the barriers to entry. Let's say that you meet all of the requirements associated with the cash flow side of things and all of that stuff. And it's just, okay, cool. What's going to perform better is usually people's next position when you're looking at something like this. And, for most people, it's great. If I put that money into, either asset, what's ultimately going to yield a greater rate of return? And if you do compare, and Vanguard has a fantastic chart with regards to this, but you compare a property investment versus a share investment. Whether you look at Australian shares, whether you look at international shares, US shares, whatever it is, the share market generally has overperformed the property market on a percentage basis. And so for some people, it's, okay, great. Well, let's put the money into shares. It overperforms. You don't need to have the barriers to entry. Your expected rate of return is going to be greater. And so fantastic, let's go down that route. But it doesn't tell the full story, particularly when you're talking about borrowing, because of the fact that, as you just mentioned, if you're purchasing an $800,000 property, you're generally not putting $800,000 into investment. You're only putting $200,000 into that investment, and the rest paying in the form of mortgage and interest repayments through the power of leveraging. And for me, and in my mind, it's the greatest risk that's associated with a property investment, but it's also its greatest benefit is
Because you are leveraging.
you're leveraging. You're magnifying your gains, but you're also magnifying your losses. You buy, in your exact same scenario, an $800,000 property. The costs are $200,000 in order to, enter that transaction. But if that $800,000 property increases by 10%, you've made $80,000, excluding capital gains tax and all of that stuff. Okay, great. There's an $8,000 profit. Not profit, but there's an $80,000 gain that's associated with that transaction. But you took that same $200,000 and put that into the share market, and the share market performed at, say, 15% returns. Well, great. That $200,000 has done $30,000 in profit for you. And even though it's overperformed what that same investment in a property has, it has essentially done more for you because of the fact, or the property has done more for you
From an
because
absolute
of the fact
return,
that you're leveraging. Same story on the downside though. Property investment goes down, it's going to magnify your losses. And so that's why property is a very attractive investment, is purely because of the power of leveraging. Now, in that calculation, really basic calculation, we haven't looked at, rental income versus the debt that's associated with it. And so that's not your total cost over the course of 12 months. We haven't looked at capital gains or dividends or anything like that. But in that simple scenario, you can pretty easily see why property is such an attractive investment, because of the fact that there's the ability to leverage. Huge amount of risk associated with that, but also a huge upside that can be done through shares. Like, you can leverage when it comes to shares, but you're not leveraging it, you're not borrowing 80% of the funds. You're usually doing it at much more conservative numbers. If you're taking on a margin loan, there's margin calls. It's a different, completely different
It's
thing.
completely different scenario. And that's a really good conduit into investor behavior. But before we get into that, I want to talk about the liquidity differences associated with the two asset classes. Like I was describing before, you can get into and out of shares very, very, very quickly for a very cheap price. In and out, right? Which is good in one respect, because you can get in and out. There's complete visibility and transparency over the transaction price. So what share are you buying or selling at? With property, that's not the case because it takes time. You don't know exactly what price you're going to get. You've got to gauge how deep the market is in terms of demand. You're competing against supply as well too. And because of the different and the cost associated with buying and selling, so you might be buying and paying stamp duty and all of the other legal fees associated with it. On the selling side, you've probably engaged with a real estate agent, maybe you've addressed the property and those sorts of things. But because of the barriers and the cost and the time associated with the two different asset classes, in my mind, what we tend to see is with property, people tend to approach it because they need time for the asset to grow in order to recoup their costs. By the very nature of how it's structured, people seem to be longer-term investors naturally anyway, which, regardless of what asset class you invest in, that's actually the approach that you should take. Right? So it's the greatest blessing and it's also the biggest curse associated with both of those, because in the share market, if you can get out and you see something like a COVID dip, like we did in March of 2020, you can press the button and you can get out in hours, minutes, whatever it looks like. Whereas with property, that's not the case.
Yeah. And so you're much more thoughtful on whether you should get out.
You're
much more cautious on, do I actually want to sell this investment? Is it worthwhile? If I put it on the market, am I going to incur all of these costs? I'm going to pay agent fees, advertising, all of this stuff, not get the price that I want, and then end up not selling, and I've incurred all of these costs and haven't actually gotten any, realization of the asset. It's, as you said, it's its greatest asset, but also its greatest curse. And you can also use that in the same way of, someone who has, let's say, invested and they've reached their retirement age, they're looking to now start to draw down on their assets. If all of your assets are tied up in property, well, then you're only living on the rental income that you've got associated with that property, and that's it. Different story. If someone's invested in shares, you're not just living on the rental income or the dividend income that you've got. You can say, hey, we are planning on doing a big European holiday. We're going to take 20 or 30,000 from our investment. And we're just going to sell a portion of the assets in order to be able to fund it. You've got the flexibility to sell, small parcels or purchase parcels of underlying investments. Whereas within a property, unless you sell the entire asset, you're kind of just stuck with the rental income and the yield that's associated with it.
Yeah, and an extension of that too is also diversification as well too. So if we wanted to buy shares, we could buy certain shares in certain aspects of the Australian economy. Like I gave an example before, we can buy some of the banks, we can buy some of the miners. We can actually make the decision to go and buy overseas. Yep. But if we wanted to buy that hypothetical $800,000 property, it's going to be in one suburb, in one city, in one location, in one street. Yep. How do we diversify with that? We can't, because we don't have the money to go and buy multiple properties. Yeah. So diversification is also a big consideration, as are the cash flow, the profiles of both of those different asset classes. You want to run us through that, Andrew?
Yeah, look, generally when you're looking at a property, and it will range depending on whether you're purchasing a house, whether you're purchasing an apartment, a unit, but for most, let's say, houses in Australia, what you're expecting is 2 to 2.5% of the value of the asset is what you'll receive in rental income. Yep. So for easy numbers, let's say $100,000 property, you're usually expecting $2,500 a year to $2,000 a year in rental income. Now that will fluctuate depending on the property, the suburb, the area, the profile, all of that stuff.
I don't know where you're going to find $100,000 property. I'm curious about that.
I'm just using it as
use $1 million.
There we go. Yeah, $1 million, you're talking 25 odd grand in rental income associated. Now that's also, incorporated within that is also the costs of some repairs, some maintenance, some agent fees, things like that. Versus a share investment that may be delivering a 4% yield, a 5% yield. $1 million in shares might be delivering 50 grand worth of dividends associated with it. And in addition to that, there may be some tax benefits in the form of franking credits, which will add to your investment rather than costs associated with receiving those funds. And so a share investment generally, and if we're looking at blue chip shares, will deliver a higher yield than what you'd expect in a property investment. So for a lot of people, or what we sometimes see clients do, is utilize property as they're accumulating their wealth, utilize the power of leveraging and borrowing in order to magnify gains by investing over the long term, and then slowly start to maybe not sell all of their properties or all of their investments in property, but as they start to approach retirement, use some of those proceeds by, selling maybe one property and putting that into, like, you can put it into a superannuation environment or a trust structure, but putting it into a share investment that's going to deliver yield, income, flexibility, and start to, really rely on the income that's associated with those investments. So really utilizing both strategies or utilizing both assets to achieve an overall greater strategy.
I guess from the timing perspective, just on the cash flow piece, so with property, the tenants will pay rent on a monthly basis. Yeah. So essentially you'll receive rent 12 times a year, whereas with shares, at least in Australia anyway, and assuming that the company is paying out dividends, that happens twice a year. Yeah. So you're talking about twice a year versus 12 times a year. So there is a bit of a difference, but once again, that just comes down to
managing the cash flow,
managing what that looks like. And if you've got debt associated with either asset, that becomes an important consideration as well too, because you need enough money to be able to service the debt associated with that. So Andrew, let's tie a bow around this. I mean, look, we've spoken about a fair bit in each of these, but don't want to sound biased to one towards the other. But what do we do in terms of our thinking? Let's give a bit of an insight into what our thoughts are, what our strategies are when it comes to shares or property. Which way do we go?
Yeah, I mean, look, the first point in call, and the first thing and this is whether you're looking at investing in shares, in property, in bonds, in infrastructure, through super, outside, regardless of what you're doing, the first point in call is get the lay of the land and understand your personal circumstances. If you don't have the cash flow requirements in order to be able to support purchasing a property, and that's not likely to happen in the near future, well, then the answer's already there for you. You've already got an understanding that, hey, I'm going to need to invest in more liquid assets with lower barriers to entry until I, achieve a certain level. So get an understanding of your own personal circumstances, understand where you're heading. If you're looking to retire in a couple of years and purchasing an investment property that's going to incur stamp duty, and then you're going to try and sell it in a couple of years to make a gain, you're taking on a significant amount of risk, because if you pay the stamp duty, you're not going to get that back when you sell. So it's understand your circumstances, understand what you're heading towards, what you're trying to achieve, and ultimately, provided that you're starting with enough of a time frame, utilize the benefits of both. The timing may be different for different clients. You might, for a particular client, we may select purchasing a property now and then purchasing another property in 3 years' time and then acquiring a parcel of shares thereafter. Whereas in another client scenario, it's, shares is the right thing now, add a property later, and do it in a different order. But ultimately what you want to do when you're purchasing assets or when you're building your wealth creation plan is have as many different options as possible, because you might build the perfect strategy, but the only thing that's certain is that it's not going to work out exactly like that, because life changes, your circumstances change, and your goals change. So have a variety of assets where you can reposition yourself depending on what's happening, both in market circumstances, but also in your personal circumstances as well.
Andrew, well said, well summarised. I don't think I can add anything to that other than that's obviously spot on. It's complicated. Get advice is probably the only other message that I can add to that. But I think we did that one some justice. And Andrew, thanks for your time.
Thanks for another podcast, Bills. Thank you to all of our listeners and subscribers. And hopefully you got some value out of that one. Please like, subscribe, and look forward to catching you on the next podcast.
Thanks.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amaritis and Andrew Nicolaou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of AMP Financial Planning.